All right, welcome to February. Let's just go through the top to bottom on our weekly and a few things about the observations from last month that carry over for this month, and just to talk about my favorite. If you've ever been to one of my seminars or taken a course, you often see this phrase that I always heard people say, I lost my shirt in the markets. I lost my shirt trading commodities. I lost my shirt. And it's just like, well, it's okay to lose your shirt. I mean, most guys, and I don't want to be sounding sexist, but, you know, most people, if you wear pants, that's where your wallet is, and that's where your cash, your credit cards, or access to more cash is. So it's okay to lose your shirt in this business. Just don't lose your pants. And that's what I meant by that. We will get nicked in the market. You will have some losers. You just don't want catastrophic self-inflicted mortal wounds in this business. And that's what I guess that message really is all about, is that we need as traders to understand that we will have drawdowns, losers. There will be losses. So we need to be, I guess there's two schools of camp. Trade a lot of times, very little, or be more selective in trade and be a little diversified, which has always been my style, the diversification. And I think that's what this room has tried to achieve and is achieving, and has accomplished that between a mix between day trades, looking at different commodity markets, different ways of trading a market, like spreads, option, directional trades, how to put the edge in our pocket. And, you know, if we understand, and as traders begin to learn, if you be patient and you understand a trade, whether it's an option, whether it's a spread, there will be a trade to do so that you're more in the mindset of not just making money, but have the confidence to pull the trigger, and that's really important. So with that said, that's why I like to go through a lot of the trades that we've done, and also to kind of review the market thoughts and observations from the prior week. So we're just going to cut to the chase. Last week's comments about you know, the U.S. dollar and how U.S.-based multi-international conglomerate companies how are they going to do? Well, they're not going to do very well. PG, Microsoft, CAT, all gapped sharply lower. However, not all was really bad, which is interesting, because while Caterpillar plunged, Ingersoll Rand, which I don't know has a lot of exposure as much to Caterpillar abroad, just posted an all-time new monthly closing high. It soared last week. Also, it seems that low gas prices caused everyone, and I don't think it's low gas prices, because quite frankly, I just filled up my wife's car the other day, and it's an SUV. And to be honest with you, I think we saved like $8. I mean, normally from a total empty tank to empty, you know, to fill up, $8 whole. And so, all right, if we don't drive a lot, $8, you know, and then you go to the grocery store and you look and you start stocking up on supplies for Super Bowl, and you figure out that a six-pack of Miller Lite's like $7. So it's like, okay, it just went from Exxon's pocket or British Petroleum's pocket to Miller Lite's pocket, and I'm not really a drinker. So, you know, I think the wine sales and food and beverage is probably picking up that. And I didn't buy the 5 iPhone, the 5 version. I waited till the 6 came out, and so I think a lot of people did. So I think one of the things that's interesting is Apple reported stellar sales with nearly 74 million new phones, and I think we have to say, what's left in them for the next year? I mean, if everyone's bought the iPhone, what's next? So, you know, you're going to wait a while before the next big bestest thing comes out. So I would really be leery of looking at Apple as a continuation trend here at this point in time. However, shares did move up and defied the negative gravitational pull of the U.S. equity markets, which plunged on Friday in the final hour of the day. And we talked about that 97 point as a reference, that if we broke underneath 97, we had that like what we call the pump and dump, where the market got pumped all the way up into the mid-teens. And then all of a sudden, it just started to feed on itself. And then late afternoon, the market just plunged in some pretty wild trading in the last hour. We had some interesting points of interest that I wanted to prepare everyone, and I'll go through that with you. But I wanted to also just mention what happened to the month, but also what happened in the week. And you guys can take a look at that. This is the weekly performance. The Spider's down almost 3%. The Dow was off almost 3%. The Qs were off 3%. And the Russell was down the least, but lost 2%. which means that the Russell is still losing less, which means the Russell's outperforming the benchmarks or the blue chips. Transportation got walloped the most at the final hours because of that big surge in crude prices. And there was a couple mixed reports of why crude rallied. A report about Saudis cutting back. B, a report about oil rig counts being offline, dropping. So it seems that maybe crude oil has found a level in which operators are no longer willing to let the spigot run and say, hey, let's just cut this off for right now, and that is what boosted the crude oil. It certainly did finally find demand as we enter a seasonally strong period of time, which is something that we've been talking about, and more importantly, as we've been talking about and identifying stocks in that sector, we're starting to get bid up. So it wasn't something that we were telling anyone, let's get short here because we think it's going to 30. So with that said, the interesting aspect, just to look at that, housing got a boost, the ITB, and I'm talking about the builders themselves. They were up 2%, and the XOP was up 1.5%. And that, again, that's due to that crude oil surge. But it did have an 8% move on an intraday basis before closing up 5.8. But to be honest with you, a lot of the stocks in the oil and natural gas sector and refiners were up already on the week. So I talk about that because if you're not sure, we can take a look at PSX, Noble, Oxy, MPC, and Valero. They're all in a weekly buy mode, and I want to share with that in just a minute. I still see strong potential in COP, ConocoPhillips, and Chevron. I'm not sure how it's going to play out in the short term, but there is an issue because on Thursday, many people may not be aware of this. We've got to pay attention not to economic reports as much as what happens on Capitol Hill. What bills are being passed, what bills are being rejected, what not monetary policies are being changed, but what fiscal policies are being changed, and or what new legislation is being implemented to allow an industry to thrive. So, for example, when they passed the ethanol bill years back, right, what happened to ethanol production, corn production? I mean, it surged. So when there's a major bill on the floor and it passes, we need to be aware of that. And I think the Keystone Oil Pipeline is one that President Obama is fully expected to veto. I mean, he's got his veto pen out, apparently. And I think this could be a really strong battle because, remember, the Republicans are going to try to dismantle Obamacare. And they're going to try to dismantle maybe some parts of it. And there could be some political, hey, we won't do this if you do that. And there's going to be some politicking going on. And that's what I think maybe this is about. And so what would be the most to benefit? Oil, coal creates jobs. What would be the least to benefit if they go and attack? Then it would be maybe the drugs. And if we take a look at what makes sense is on a technical basis, we look at the drug stock, the drug sector. We look at the biotech sector, which, as we all have been seen and talked about, is in the stratosphere, and this is in the tank. So there could be a change of heart, which could cause nervousness amongst institutions with overly, I'd say, imbalanced long positions in those sectors and underexposure to the energy side. So that's just a food for thought that I would be considering. In this room, as a diversified, we've done a lot of really great setups in not just day trading in the wild equity market, but we've done a lot of things like filtering out for Starbucks. Last week, we had some interesting moves that just didn't look like they were going to take off one way or another, such as Facebook, so we didn't have a lot to do there. But, looking at moves like the trade in the live cattle, ways to avoid high risk and then enter in high probability trades. Really neat stuff, I think, that we've done. Breakdown trade, how to look for breakdowns in gold. Friday's breakout trade setup in crude oil. I mean, there's no way that we plan for an 8% move intraday basis, but we did give you the setups and what to look for on a breakout and why. Because Friday, typically, traders don't want to be running short into a weekend, especially after a big down move, in case a supply disruption, a war breaks out, something happens. Nobody's going to have that. Well, it was a little bit more than that, and So that was some really, hopefully that aided you into what to look for. We also pointed out what to look for as a breakdown. We did not discriminate. We weren't just entirely bullish in the stock market. We said if this market breaks 97, it's got some problems to the downside on a Friday. So that was the pump and dump was mentioned in Friday afternoon session here. And that's just to mention a few. And then generally, as you guys know, I try to tweet this stuff out to traders. So anyway, what does this next month and week look like? Well, we have big earnings coming out this week, and we have one major economic report, and it's generally just, as everyone knows, the unenjoyment report, as I fondly joke about calling it, the unenjoyment report. The monthly employment numbers are coming out. The Bank of England is going to come out with an announcement on their monetary policy. Weekly, API, energies, all kinds of stuff you can see at the bottom of this week's sheet. And that's why I talk about the major stock indices. The other day I said, it's not really bullish that they close on the low for the month. It's typically not a bullish sign, but we're still in a range, and we wanted to watch to see if they close below certain levels. So we can jump around, and I thought we might see some follow-through early month weakness. And overnight, the market opened unchanged, traded a little higher, and it got slammed testing Friday's low. If we do see weakness going forward, or if there's doubt about a specific market, I cannot still imagine biotech, which is up on the month, the beginning of the year, let alone last year's move, let alone the year before's move. I can't see biotech acting as a safe haven spot, meaning let's get out of everything we own and go pile into biotech. I can't imagine this still being the hot spot that everyone wants to be in, and if they are, I think smart people aren't going to stay with it. I think they will probably do what we call not asset reallocation or sector rotation, but they may reduce their exposure, causing some selling pressure. So I'm expecting large institutions and funds to initiate that sector and asset reallocation, possibly out of IBB and drug stocks. DRG is the ETF there. We typically enter a very pronounced seasonally weak period of time coming in the month of February for those sectors, which can wreak havoc on the NASDAQ sector, the Qs that is. And I think we want to look at, and I'm going to scan for opportunities in the small and large cap discretionary sector stocks. Interesting on the news, still talking about how people are moving out of parents, they call them the basement kids. They're moving out and renting apartments. That's great. But, for the last 2 years, not this year, but the last 2 years, people have been in apartments because they haven't qualified for mortgages. And we know that because that's what we've been told. We've been told that people aren't qualifying for mortgages. It makes it more difficult and difficult. And so perhaps we saw some changes on Capitol Hill, reductions of your down payment. I think now for a Fannie Mae or Freddie Mac is 3%, right? I mean, when I first got my first home, I put 20% down. I had to save 20% down. Of course, home values were different, but interest rates were also at like 14% on a mortgage. So, we can all do business. Every one of us can do business with a higher interest rate environment. Think about it. What was this economy doing in Reaganomic years? Interest rates were coming down, but they were still notionally high. And so what I could tell you is this, that I think that the market may be a little bit nervous, and that's what the market is. Anytime markets move up strongly, they get nervous on major changes. Well, we do have changes. The dollar's rallied. There's quantitative easing going around the world. People are afraid of consumer spending declining, but all over, from China to Australia to Europe and even here. And I think that we're going to start to see people start to spend as we've seen this buildup of employment, which is not great white-collar jobs and high six-figure paying jobs. But I think that for the most part, we're going to start to see money go into the high-ticket item, and that's what maybe the ITB, the housing sector, is showing us, that people are starting to look at homes. We also want to look at existing home sales going forward too, because I think with Home Depot prices and Lowe's prices and people looking at lumber liquidators. I think people are more able to want to do it themselves, get a value, get a bargain, save money. And so in the next 8 weeks, I will be focusing on not just new homes, existing home sales, all right? I think that's going to be important. And there's several private, RE/MAX puts out a private report, and I believe Zillow also has kind of a report on traffic, ad spaces for realtors, et cetera, et cetera. So we want to start focusing on some of that as well. What I am going to be leery of is larger department store, especially Kohl's, KSS. It has a significant tail or long shadows of the last 6 or 7 weeks, near 62. I'll share that with you. Also, Ross signaled a weekly PPS signal, and Walmart made a monthly shooting star, which has got to be one of the ugliest looking candle patterns that I've seen on bearish volume divergence, and as well formed a weekly PPS sell signal. Support is about, $5 to $8 lower than where it's currently trading. So I want to look at that whole segment of the market moving forward. So from a technical perspective, remember S&P's 2 weeks ago, we were in the S&P 500. Just 2 weeks ago, we had 358 stocks in the S&P 500 above their 10-day moving average. As of Friday, there were only 96. So I think we're a little oversold there. The daily McClellan oscillator, while it did break the zero line, and I don't want to see that, this is the questioning part that is slightly confusing, to be truthful. The McClellan oscillator is based on the NYSE, and the NYSE has a lot of bond funds and preferred stocks. The McClellan oscillator and the NYSE, and here is the NYSE on a weekly basis. While this looks ugly in price terms, volume doesn't look nearly as ugly as it should, and this is a weekly chart. But here's the thing about the NYSE. The AD lines are still positive, at least they're still pointing up and holding the weekly moving average. So when I look at the McClellan oscillator, I need you and as to well to understand that how much weight of bond funds really can weigh in on the AD line. And I think as a broad-based stock sector, we want to look at all of them to look at broad market analysis, a broad-based segment. We don't want to just trust one market. So when I look at the McClellan oscillator, I go, well, gee, it did break the zero line. The weekly reading is now at negative 80. And all the stock indices, the spiders, the Qs, the Knights, the diamonds, they're all in a weekly sell mode. And again, OIH and XOP closed positive on the week. And so I have to say, well, maybe perhaps if energy prices continue to rebound as we've been predicting and saying it might be just in a trading range, and get back up to 50, 52, we notice overnight in just a heartbeat, this crude oil market, popped pretty darn significantly. Most of you are probably, if you're not aware of it, take a look at that print at 50.56 in crude oil. Pretty amazing stuff. So needless to say, this could weigh in on the oversold energy sector, and we start to see money coming back and trading in that rotational type of pull. So this is where it makes it a little bit difficult. Bullish setups. As far as technology is concerned, I still like Riverbed, Microchip, NVIDIA, ETR, and Rubicon, which I've posted all the earnings. We're out of the woods on earnings on Riverbed. We're out of the woods on Microchip. We're not out of the woods here on these next three. Energy sector, I still like COP, Diamond Offshore, GNE. I don't know when earnings has. They did not post it, or I could not find it. And then here's another small cap energy name, BCEI, earnings at the end of the month. Just take a look at these names still for bullish setups. Bearish setups, biotech, the IBB. I like the March puts, the 280 strikes if we do get a little pop, or I like looking at the 330, 340 credit spreads for about 4.5. And, I think that the credit call spreads, you're risking $5.50 to make $4.50 if you get that price. And Industrials, RSG is another one that I'm not too fond of. Seasonal spreads. You say, well, John, you cheated because this was all last month's stuff. Well, April crude, short April crude, or excuse me, long April crude, short April heating oil is still in effect until 2/16. Buying April feeder live and selling March feeders is still in effect through the middle of March. Buying the Canadian and buying the Aussie, selling the Swiss franc, and these are still in effect through March. Now I do have new trades. Buy May copper. It's a bull spread. You buy the front month copper, sell the back month on or about 2.4. You buy July bean, sell July bean meal on or about 2.9. That's a longer term trade. You can trade around that as a trending market. Buy July beans, sell July corn on or about the end of the month. Liquidate before May 4th. Buy June hogs, sell June cattle towards the end of the month on or about 225. Liquidate before 518. Nice little trade there. And what's interesting about this is hogs have gotten just smashed to the downside, and cattle's kind of rebounded a little bit. So if you get more rebound in cattle and hogs don't move, that might be a great spread opportunity. So if no one's really focusing on this, I thought I'd shove it in your face just to, go through and take a look at what are these, not to shove it in your face, but just as a reminder pleasantly to say, hey guys, if you're not interested in spreads, why don't we take a look at them? Because what are they doing? I mean, if you don't have a reference point of what a spread is, if you don't have a reference point of what it's doing, if you're just in options and you don't have the skill set for spreads, simply just open up your TTU manuals and and just restudy the spreads. They reduce your margin. Seasonally speaking, a lot of these trades make sense. I talked about why I liked the currency spreads earlier many times, right? And so I thought it'd be nice to just say, hey, on this date, on the close, we're supposed to be in, this is the long crude short heating oil. While on that date, it provided several profitable exits. You took a little bit of heat. If you're still in, that's where the trade, the crosshairs are. The vertical line is the date, and the horizontal would be the price of that spread. And you can see you clearly had a chance to get in and make money, and you're still making money in that spread. So that's seasonal spread work. This is the Canadian Swissy spread, and the other version was the long Aussie short Swiss spread, as you can see right here. And they were both entered, or you are looking to enter on or about the same date. So it's just a matter of which one you like more preference. So the charts are very similar in nature. So this is the chart on the Canadian versus the Swiss in terms of the futures market. Okay, again, when we did seasonal analysis, Forex wasn't around, number one. Number two, we used the commodity data since we've been trading foreign currencies since 1972 via the IMM. It makes it very important to use historic data and transparent data. You don't have transparent data trading through these Forex dealers. So I wanted to illustrate the price structure on the commodities, comparing an apple to an apple, a one-to-one ratio, which is how we used to do spreads, so that you can see the trend direction. If you're long the first contract and you're short the second contract, then you want the spread to get more positive. In other words, you want the spread to move up, just like here. If you're long crude and short heating oil, you want the black line to go up. And if that's your entry here, it's real simple. That's the defining line between north of that is a profit, south of that is heat, loss. Okay? We define heat as losing. Having the trade move against you is how much heat you take on a trade. And even as of Friday, the spread still working. Look at this nice performance of the Canadian as well as the Aussie moving positive. Here's the live cattle feeder, which hasn't really provided a huge move. Last week, though, we said, hey, guys, let's do some bull spreads. We called that to the tick, and you had a chance to get in at 5 double nickel. I did tell people to get out around the 670 area because I thought we would see a pullback to about the 610 area, and I still think we're going to see a pullback in that spread. As far as today is concerned, going through, and I just thought it'd be nice to say, maybe we aren't paying enough attention to this and it's just on a piece of paper, or perhaps there's so much going on in our daily lives and daily trading that we forget about some of these spreads. And so I wanted to just get them back and say, hey guys, these spreads are still valid on pullbacks and we can watch that stuff. All right. And here's the performance of them. So if you don't, know what you're doing, at least now you've got an opportunity to learn about them. And last week we did some really nice stuff with spreads. So today, as you can see, the big news will be probably the ISM, the PMI, Purchasers Managers Index at 945. Then we've got a Fed speaker coming out at 10 a.m. tomorrow, another Fed speaker at 12:45. I don't list their names because it's not important. Unless it's Janet Yellen, I don't care, to be honest with you, really. I mean, what are they going to say? We're going to raise interest rates tonight? Really? I don't think so. So I just want you to know that a Fed speaker is coming out at that time. So if you're about ready to do a day trade and they say, yeah, well, I vote for higher interest rates soon, he might cause the market to move, or she. And so we want to be aware of what time these reports come out so you have clear sailing. ADP jobs, Euro, I think is important to find out. What's the Eurozone retail sales coming out Wednesday, 5 a.m.? We got a bond size. How much is the government going to issue in 10-year notes and 30-year bonds? Supply, that's what that means. Lots of supply, little demand means prices go down. Little supply, lots of demand, price goes up. You also look at your ISM non-manufacturing. That's more of your service sector. And then you have the Bank of England, Challenger job cuts, weekly job number. And then German industrial production's out at 2 a.m., but the big granddaddy of them all is going to be that guy right there Friday. Here's your earnings reports. And so there is our monthly analysis, what sectors I like, what sectors I think are going to perform well. Now let's take a look at a couple markets. Last week we talked about coffee having a daily high close doji. One of our students talked about an ETN, an exchange traded note called CAFE, CAFE, on coffee. Coffee formed that buy signal, formed a doji, came slamming right back down. Now, we are entering that seasonally strong period of time. And I want to share with you this daily chart here, because as the market slammed down, the volume continues to show not a lot of liquidation. So we put out information that we want to watch to see if this market trades through and above not just this resistance of the moving averages, but the daily opening range. And I think also we want to look for any moves back through that day, which is a last conditional change, a low close doji, a close above that level, and I think this thing would be off to the races. So while futures might be a little bit different, here's something that's kind of interesting, because when we examined CAFE, we noted that on Friday the market traded up, not down. Traded up, not down. So that could be a little anomaly where the back month futures, not all the coffee contracts, just this could be, as we see, this is now the beginning of February, and it could be that we get March coffee gets liquidated because, we're going to come in and for long-term buy and holders, you can't really first notice days in less than 2 weeks. So we're not going to get a buy and hold mentality in March coffee, but if we take a look at KC and go with the May contract, you'll note that it's not as bearish on the downside, but we want to look at May coffee, not March, and also this is about, it's trading at a little bit of a premium. Watch this opening range or a close on a daily basis, not above the doji high, that'll be nice, but above this last conditional change. All right, so I think that would be one to watch. There's the opening session. A couple things I wanted to point out to you as far as buy signals, stocks that generated a buy signal in a weekly mode, Biogen, Costco, the problem that I have on both of these names, let's start with Biogen. While Biogen generated a buy, and it was a specific reason it generated a buy, let's take a look at this monthly chart. There were earnings the other day. So on a month-to-month basis, and this is not short-term, and this isn't because it just didn't trade over one month to another, but from the peak high last year, before we saw that little downside action, we noted that it really didn't go anywhere as far as a trend reversal, and it finally took off these last 2 months. This, on a monthly basis, shows pretty significant volume divergence, number one, on a higher degree time frame, and number two, it's pretty much, if you note here, I want to zoom this up for you, where is the current price relative to the blue and gold moving averages, right? So first and foremost is the moving averages have a wide separation, not narrow, wide separation, and prices have expanded well beyond the means. So a light volume rally on a monthly basis with large separation between not just one moving average and price, but between both moving averages and then price. Just like over here, wide separation of moving averages, price departed. What did you see? Big correction. So I think this is one that is a setup for a bull trap, especially if you note we are near an important longer-term pivot resistance, okay? So what is this? Quarterly pivot resistance. So this is one that I'm really, you know, if it has a lot of weight to the biotech sector, I'm not all that interested in that one. I just wanted to kind of point that out to you guys, all right? And in summary, let me go through two other names that I wanted to talk about or just share with you. When we take a look at some of the industrial stocks, and they say, well, it's not doing that well. It's not that a lot of stocks did okay, and this is Ingersoll Rand, and for whatever reason, it's take a look at a weekly chart a little bit better. As far as IR is concerned, I mean, it broke out. It made a new high. The only aspect that I have is that the volume and the momentum is waning. So it's just showing me that not all stocks are negative in this environment. Noble Energy, Neighbors Energy, Occidental Petroleum. Obviously, these are names. If you take a look at Noble, look at the long shadows. If you take a look at Occidental Petroleum, not only do we have long shadows, but we had a doji on a monthly basis, and as prices made newer lows, they didn't close near the lows, so the decline and the bearish conditions, which means lower highs, lower lows, close less than open, close closer to the low, close below past or prior lows. All of a sudden, when someone asks, well, when does a bearish market condition cease to exist? When is this market going to rally? Well, I tell people when the bearish conditions reverse. Now, all of a sudden, you get a market that makes a, yeah, granted, a lower low and a lower high, but it closes above the open, closes closer to the high. Next month, it forms a doji, closes, makes a higher low. And so on the volume analysis, it also makes a very light volume breakdown. So when I get these light volume breakdowns, and the market makes these light volume breakdowns, I like to say, well, what constitutes that? What's the short term kind of look like? And then we look at the weekly and we say, oh, really? I'm going to get short this sector and no one's buying? Well, the volume, if it precedes price, which it did, volume broke out in Oxy. This stock, the next stopping point is going to come up to test this. This candle is the last conditional change. That will offer the first test of resistance besides this level. So once you clear 84, your next test is around the 89.5 area. That's a $5 move. If you think about it, I mean, it's about a 6% run-up. And it's not just that I'm focusing in and picking on Oxy. I also want to look at the entire energy space, okay? So that's kind of what, if we look at the energy space and say, well, what is relative performance doing in the market? Yeah, all of a sudden, any of the shorts that are in the market are probably getting squeezed to, you know, and the whole entire sector this morning is up 2%, which is, if you have exposure to that, is great, okay? So needless to say, when you read the news, sometimes it doesn't behoove us to do well. As far as day trading today, I'm not going to pussyfoot around, Batman. I'm going to tell you straight up. If you can see the way this market did the old pump and then dump, and we talked about the market breaking down below that swing 3-bar reversal, it would have trouble, and it did. Now, what do you think this market's going to need to get back to the upside? The market paid us good information and just shared with us we had a last conditional change candle that all week this market couldn't get above on a closing basis on a 60-minute, 15-minute, I don't care, take your pick. Whatever it is, 2020 is a big voodoo, taboo, big resistance number. If it clears that number and I'm not around and you see it clear by a close basis on an uptick in volume, I can probably assume that the market is in a strong trending breakout mode, and we're going to probably go straight to the to this 2060 test the highs one more time. Now for the downside, I get again nervous if we close below 1980, and I think that brings us to, believe it or not, and I'm going to state this number out loud. If we get a daily close under 1980, I think we've got 19.25 to 1880 coming in the charts. Let me share with you what I'm looking at for S&Ps. If by chance we close, once again, under this 1980 level on a daily basis, note, we have not done it at all. We've traded below it, but we've never closed below it. If we close underneath that level, which we've already been through, after testing it, if we close under 1980, my analysis suggests that not only are we going to come back down to testing perhaps this level, which is a green line, which is 1912, okay, maybe we get a little bit near that, but I think we could also test this area here where the market made the 1880 low, which people may have forgotten about, which is August low, as well as if you take this big spike 1-2 day out of the picture and you look at the average or the area of point of breakout on the moving average crossover, that's what the market may get to. As it is right now, we saw a big volume, a big price decline getting lower on light daily volume. Tough to get still bearish in the hole here. So while day trading is going to be wild and woolly still, make no mistake of that, I think we need to respect those levels. And unfortunately, I have to tell you, on my analysis, looking at this ES chart, it's still in a range. And what do you do when a market's at the bottom of a range? You close your eyes and you buy it, or you buy it smartly, okay? Or you wait for the suckers to get wiped out and you buy on a confirmed breakout. And for me, it would be we need to get above this 2020 level, all right? So I will, as the week progresses, give you guys some more insights and, again, whatever we see as far as trading in the room. Crude oil is still going to be a wild and woolly market. They're still looking to sell rallies above 50, obviously. We talked about that in the room. I said I'm not looking for the market to get to 80 any day or hour soon, but certainly we could see crude oil and test the back of the upside of the range, because stocks, commodities, markets typically do what? They go from a strong trend to they change into a consolidation level, right? Isn't that what happens? Eventually, our analysis would show that, we were losing bearish momentum in the market. We talked about the whole scheme of things about the market condition. And I just, not to get too excited, but I do think the market's now demonstrating, and here's the range of the market, right, that we are going to come back up and test the range. And we would love to see the market come back and test this high, and it's really this last conditional change, this guy right there. And, you know, over time in the next 2 weeks, we might, if we maintain higher lows, if we maintain positive volume, my first and foremost resistance level would be somewhere near the 53.5, 54, give or take, something like that, right up against, and just to share with you what that number is, view data window, you can see it yourself, the high is 53.12. So we already tested it once, not as significant as we like, which was 51.73, and in the scheme of a market trading $5, $10, $20 in short order, I mean, we were at 59 and we went to 49. There's a $10 move. The fact that the market came within a buck of that high, that's my point I'm trying to make. I think that this is an area that we're going to stay range bound until we close, until you get a daily close over that last conditional change candle. But it certainly put on a little surprise for all of the people that thought the market was going down. And as you note now, and as we share with you, hey, you got newer lows in price, which we said be careful of. And what our analysis shared was also we've got a bullish convergence in our momentum numbers. So needless to say, I'm not still looking for this thing to shoot up to 80 bucks by any stretch of the imagination, but I believe we're still stuck in a range, and we need to see over the next day or two to see if this positive performance maintains and doesn't fail. I just, at the very least, would say we're in a trading range environment, and we are still, as consumers, pumping gas, using gas, and so that's why I think the refiners and the providers and distributors and that whole scene was doing well in the marketplace. So that concludes today's and this week's planning and scanning, and we'll get back to our normally scheduled trading room. So thank you all very much.